All right, so thank you all for joining. Um, we still have a couple people attending, so still coming in. We'll get off here in a couple minutes. This is the third in a series from Demotech on industry updates. This one will focus on the title insurance industry. Um, we will lead off with a statement from counsel, but you are in listen only mode. So if you have questions, which we encourage during the broadcast, just type your questions into the questions portal, and we will get to the answer at the end. If we can't get it, then we will email the questions and answers out to all attendees. A copy of the presentation slides, as well as a link to the recorded video, will also be made available probably early next week to everyone who's registered. This session is being recorded, just for your knowledge. So, Burke, if you could go ahead and give us the opening statements. Thank you.
Sure, thanks, Paul. I just have a couple of introductory notices for the participants. First, because participants on this webinar are or may be considered competitors in the insurance marketplace, we are providing an antitrust statement. You acknowledge and agree to avoid any conduct that might violate or create the appearance of a violation of any applicable antitrust laws. This webinar must not be used as a means for competing companies to reach any understanding or agreement, whether express or implied, that restricts competition or in any way impairs the ability of companies to exercise independent business judgment regarding matters affecting competition. Participants must not discuss or agree upon any terms of trade or business strategy concerning products they have or may offer in the future. Such terms include, but are not limited to, prices or premiums, business volume, underwriting terms or standards, market share, customers, types of business written or avoided, coverage terms, territories, reserves, incurred but not reported claims, or profitability. It is your responsibility to be aware of antitrust regulations and antitrust compliance policies and to prevent any type of discussion that violates the same. Okay, we have an additional notice here. This webinar is for informational purposes only. Demotech does not make recommendations to companies that we review and rate, and so nothing in this presentation should be construed as a recommendation. In addition, we will be discussing various metrics and trends in the industry, but please note that when assigning and monitoring financial stability ratings, Demotech assesses a number of factors, and an FSR reflects our opinion of the overall financial stability of an insurance company. Okay, with those two items out of the way, I will move on to introduce our speaker for today. So presenting today will be Doug Powell. Doug is a senior financial analyst with Demotech. He joined Demotech in 2006, bringing experience as an auditor, accountant, and analyst in the nonprofit and governmental sectors. Since then, his work at Demotech has included providing financial analysis and rating support for title and property and casualty companies. He has undergraduate and graduate degrees in business administration, majoring in finance and accounting. We also have Barry Kessler on the webinar with us today. Barry is Demotech's Chief Ratings Officer. He directs the team, resources, and overall process of reviewing, rating, and issuing financial stability ratings. Barry joined Demotech in 1995 and holds the Chartered Financial Analyst designation and is a graduate of The Ohio State University with degrees in business administration and actuarial science. And now I will turn it over to Doug.
Thank you, Burke. All right, so today we're going to be discussing the state of the title insurance industry. And then we're going to get into some key financial metrics. And then we'll talk briefly about some industry topics. Okay. So Demotech has been analyzing title underwriters since 1992. So before we get into some financial numbers, here's a look at the number of title underwriters assigned a financial stability rating in each year. We only look back to 2005 because most of the financial results we're going to be looking at today will be over this time period. Keep in mind these numbers on this graph represent only underwriters assigned an FSR, and that the data that follows will include some underwriters not assigned an FSR as they submit the data to us anyway. So some real quick observations. There has been some consolidation since the peak in 2006. But since 2014, we've seen more underwriters entering the market than leaving. We'll also see that despite this consolidation, the financial stability of the overall industry is strong. Okay, so a snapshot of 2024. On the left is direct premium market share by groups in 2024. And on the right are some financial results and a high-level macro look at the balance sheet. So let's take a closer look at some of these results. All right, I'm pretty sure some of the attendees, if not most, joining us today, this is kind of what they like to see and talk about. So we're gonna spend some time and talk about direct premiums written. So obviously this is direct premiums written over this time period. The amounts are in billions of dollars. And it's the aggregate the industry wrote in each of these years. So let's take a look at some of these changes. So these changes year over year, they may seem dramatic, but it is important to know that these changes in direct premiums written, they are not indicative of unprofitable operations. We will see this later, but for now, let's just look at a few different changes from a few different years. So title underwriters had a record year in 2021. And since this peak, direct premiums written has decreased 37.8%. But if we stretch this out further and go back to 2005, with all of those increases and decreases in premiums over this time period, direct premium written has remained relatively the same, only decreasing 2.8%. Here's another look at those years, but this is from a jurisdictional standpoint. So these are the top 5 states in those years, as well as all others. So, you know, some things to note here, not much has really changed in terms of who are in the top 5 in these years. California and Texas switched spots from 2005 to 2021, and Arizona replaced Pennsylvania from 2021 to 2024. Also, what's not shown here is Pennsylvania was actually number 6 in 2005 and 2021, and Arizona was number 6 in 2024. So a lot of similarities. All right, let's take a look at some economic factors that impact the title insurance industry, and then we'll also see if there's any correlations to these factors. So let's talk about 30-year fixed mortgage rates. Obviously, lower interest rates typically lead to more home sales as mortgages become more affordable. An increase in home sales in 2021, that can be attributed to the incredibly low 30-year fixed interest rates. But housing inventory, it was tight, which caused the housing market to be very, very competitive. This competition led to higher home prices. Then the 30-year fixed rate surged in 2022. They rose approximately 3% in January to 7% or slightly higher in October of that year. And these increases slowed the housing market. So some of the factors in the 2022 surge were inflation. Inflation escalated due to the labor shortage and supply chain shortages. And this was then exacerbated by the pent-up demand. And then the Federal Reserve raised interest rates multiple times in 2022 in an attempt to combat that raising inflation. All right, so is there a correlation between 30-year fixed mortgage rates and direct premiums written? So the solid line is direct premiums written, and the dashed line is the 30-year fixed mortgage rates. And so generally speaking, yes, there is an inverse correlation between the two. That just means when mortgage rates fall, people tend to purchase homes and refinance existing mortgages. When mortgages rise, when the mortgage interest rate rise, home prices and purchases and refinancing slows, which ultimately leads to a decline in direct premiums written. So again, a very strong inverse correlation. Let's take a look at some inflation rates over this period. Inflation affects affordability as well as overall buyer sentiment. The average inflation rate for this period is 2.5%, and the cumulative inflation rate is approximately 60%. So in other words, $100 in 2005 is the equivalent to around $160 in 2024. But since 2020, the average inflation rate is approximately 4.2%, and the cumulative inflation rate is around 21%. So $100 in 2020 is the equivalent to $121 in 2024. So something else to note, in 2009, there was deflation. That's a negative number there, if you can see it. And that was brought about that financial crisis. Demand of goods and services plummeted. The banks stopped lending to the levels that they had been leading up to that, which obviously decreased borrowing. And also in this time period, the housing market bubble burst. So, is there a correlation? So again, the solid line is direct premiums written, and the dashed line this time is the average annual inflation rates. So there may be some correlation, but it's more indirect than the mortgage interest rates. So inflation really influences the mortgage rates and the home prices and market activity, but it's typically lagging. So as the Fed raises interest rates, then mortgage rates go up, then home buying slows, then eventually title insurance volume will drop as well as premium. So again, the mortgage rates would appear to have a stronger correlation to direct premiums written. So next factor we'll look at is unemployment rates. And so, I mean, obviously, low unemployment encourages purchases of all kinds, including home purchases, simply because people have jobs and they can afford it. There appears to be some correlation here between unemployment rates and direct premiums written, but not in 2020. So 2020, I think we can all admit, was a very unique year all the way around in a lot of ways. And during that time, a lot of people left the workforce for a lot of different reasons. And so that's that spike that we see there. So is there a correlation between these guys? There might be some correlation, but like inflation, it would appear to be more indirect. While the higher unemployment rates might lead to lower premium, and lower unemployment might appear to be leading to higher premium, in 2020, the unemployment rose significantly, but also premiums. So again, it would just appear that mortgage rates being at those historic lows in that time period coincided with premiums rising. And in 2021 through 2024, mortgage rates have risen and premium declined. So again, it would appear that mortgage interest rates would have a stronger correlation than an unemployment rate to direct premium written. All right, one more. So let's look at the median home prices. This is the median home sales price, sorry. So prices declined from 2008 to 2009 due to that financial crisis. Then we see the steady growth to 2020. And then there's the significant increases in 21 and 2022. And then we kind of see in 2023 and 2024, these sales prices have pulled back some. And again, mostly due to the higher mortgage rates. So let's look at this correlation here. There definitely appears to be some positive correlation. As the median sales price rises, so does premiums. But premium is also dependent on transaction volume. And that volume can be affected by higher mortgage rates. I think you know where I'm going with this. So median sales prices increased or remained high, but rising mortgage rates caused that sharp decline in premiums. So once again, mortgage rate seems to have a stronger correlation to direct premiums written. And then we'll take in a little bit, we'll take a closer look at 2022 and 2023 that might help explain some of this. So as I just alluded to, let's talk about some volume. So here are the number of policies written in each of these years, going back to 2012. So you might be asking, why did we only go back to 2012? Well, that's because that was the year that the information began being reported to the NAIC. So we don't have it going back any further than this. So we'll stick to this time period for this section. So bringing that direct premium written back into the conversation from the volumes, we can see that the increases in direct premiums written correlate with the number of policies written. Okay, so 2017 and 2018 were exceptions, but in all the other years, the number of policies written increased, and so did the direct premium written. But here we look at the average direct premium written per policy written compared to the number of policies written. And there is no correlation. What we're likely seeing here are the effects of the other factors: the home prices, size of loans and rates, the demand. Those factors can affect both the number of policies written and premium. And so in 2020 and 2021, seeing those high volumes, but lower average premium, it's most likely due to the volume of refinances that happened in those years. So let's look at some key financial factors, and this should attest to the strength of the industry. So we'll start with policyholder surplus, just because it's important. It's an important factor. It's important because it's used in determining financial stability. So ultimately, this is the protection an underwriter has against claims, losses, and risks. And here are the year-over-year changes. As we'll see here in a few moments that just like direct premiums written, the decreases in policyholder surplus is not indicative of unprofitable operations. These decreases, especially in the later years, are mostly a product of dividends and excess capital coming out of the underwriters. So from its peak, the record-setting year, from the peak of 2021 to 2024, policyholder surplus has decreased 16.4%. But as I just stated, this is mostly due to dividends and excess capital coming out. So in 2021, underwriters reduced policyholder surplus through nearly $1.7 billion in dividends and excess capital being paid out. And then in 2022, there was over $2 billion in dividends and excess capital being paid out. In 2023, it was approximately $1.2 billion. And in 2024, it was nearly $860 million. So that's roughly over $5.7 billion in dividends and excess capital being paid out. But in that time frame from 2021 to 2024, policyholders' surplus only decreases $1.2 billion. So $5.7 billion in dividends, but policyholder surplus only decreases $1.2 billion. And then if we go all the way back to 2005, policyholder surplus has increased 27.1%. So how do we know that that's adequate capital? So we're going to look at a couple more ratios here. So this is liquidity. Liquidity is liquid assets divided by total liabilities. Cash, stocks, bonds, mortgage loans, and real estate are some of the liquid assets. Liquidity over this period has increased. And generally speaking, when we look at companies, any result over 1 is considered acceptable. But just remember, any of these metrics aren't important by themselves. It's the sum. It's the sum of it all. So here's leverage, and this leverage is defined by total liabilities divided by policyholder surplus. And so liabilities here include the reserves as well as other liabilities such as commissions payable, payables to the affiliate companies, and payables to taxes, licenses, and fees. And it definitely appears that title underwriters have been and remain adequately leveraged because generally speaking, any result under 3 is considered acceptable. So inside those liabilities were the reserves, and the reserves are money set aside to pay future claims. And so in this calculation, we used known claim reserves, statutory premium reserve, and the supplemental reserves. And so it's those reserves to policyholder surplus. And what we're seeing here is it really hasn't changed over this time period. And so again, in general terms, anything, a result under 2 would be considered acceptable. And so, all right, let's bring direct premiums written back into this. So direct premium written to policyholder surplus, which is also sometimes referred to, it's sometimes referred to as premium leverage, the premium leverage ratio. And this essentially measures the insurance risk an underwriter has taken relative to its surplus. And so generally speaking, result under 6 is considered acceptable. And then here, finally, we have the income statement. So like all of those ratios we just reviewed, along with the policyholder surplus, like that would tell us that the title insurance industry in its aggregate is well capitalized, properly leveraged, and has the means to address its risk. And so the bottom lines, the underwriting results, the investment results, and the net income here, one net loss. So during this period, title underwriters reported net loss only once, that there in 2008, And so out of these 20 years, 19 produced net income. And so when we're looking at the industry or companies, what we would want to see, and I think it's demonstrated here, is that the underwriting results are the primary driver in the net income and how title underwriters are making their money. And so again, you definitely see that plot along with that dotted line compared to the bar there. And so underwriting results really drove the net income from 2012 through 2024. All right, so a couple extra things, some industry topics. First, we'll talk about defalcations and escrow theft. And so most of the attendees today know what defalcations are. Defalcations are typically a theft or misuse of funds. Those funds are intended to be distributed for a real estate transaction. The usual perpetrators of this theft or misuse is agents. In some instances, they use funds intended for one transaction to cover another. And this is sometimes the result of the agent pocketing funds previously and now needs money for a closing. So a logical question to ask is, how are underwriters mitigating defalcations and escrow theft? So underwriters are using a multi-layered strategy throughout the industry. They utilize oversight, audits, technology, and in some cases, bonding requirements. So underwriters typically have a robust vetting and onboarding process when it comes to appointing new agents. So that during this, they would conduct background checks. That's a key component in the vetting. That's going to be personal, financial, work-related. And then once they become an agent, the underwriters, for the most part, conduct regular and targeted audits of the agents. And these can be either scheduled or unannounced audits. Reviews of escrow balances, disbursements, closing files, and the documentation are all audited. Those are some of the things that are audited. And then underwriters have been using automated reconciliation software, such as Rhino Live. They've have long since used dual authentication for disbursements as well. Sometimes it's even more than dual, multi. And then a lot of underwriters have begun requiring bonds. So E&O insurance, as well as fidelity and surety bonds, might be required of agents handling those escrow accounts. So this one's been talked about a little more frequently, especially if you're watching the financial shows. Deed theft or title fraud is the illegal transfer of property. This kind of fraud typically targets the elderly and vacant or even distressed properties. So how is deed theft impacting the title industry? Well, title insurers may face claims for failure to detect the fraud, and these claims can become costly and involve litigation. Chains of titles need to be examined closer for fraud. This may include more reliance on manual reviews. So there'd be a cost component to that. The cost of training underwriters and agents to detect fraud, or investing in fraud detecting technology as well. All of these things are going to be costly. And, reputational damage. If there's a belief that title underwriters and insurers are failing to protect policyholders, especially when it comes to the elderly or disabled, low-income individuals, it's always going to create a negative perception, and so that reputational damage again could ultimately cost more than money. So, in summary, overall, the title insurance industry is financially stable. Title underwriters in aggregate are well leveraged and well reserved. They remain liquid and have adequate capital to address those claims. And title underwriters remain vigilant in fighting defalcations and fraud. So that's the end of my presentation today. So in the words of David S. Pumpkins, are there any questions?
Yeah, actually there are. From your early section on the economics, you were discussing the inflation rates and stuff like that. So the question is whether the premium dollars surplus, are those actual reported dollars or were those adjusted for inflation?
They are not adjusted for inflation. Those are actual dollars.
Okay. If anyone else would like to type in a question, we can get to it. If not, feel free when you get the email, you can reply and ask further questions. I'm sure Doug will endeavor to get you an answer. But that is the conclusion of today's webinar. We will give it a few seconds to see if any other questions come through. We should get out the video and slides early next week. It takes a while to render and get up onto our YouTube channel. This concludes the series. We did P&C, health, and title. If you want to see any of those, I'm sure an email will go out with links to all three if you discover you have interest in the other industries as well. Thank you for attending and look forward to our email. Thank you.